Okay, now we will start the revision program, which is the we have a very less time period, but even with that time period, I need to cover the key things which under your examination paper. Therefore, Lamai, now the issue is all the questions relevant to up to now, all the past papers, pilot papers, I have discussed with this program. Then therefore, I have selected questions from the revision kit. And I thought it's good, the fundamentals and the application questions are there. Therefore, I thought it's good to do not all, but most of the question with its reference to non-resident taxation and international taxation. I have selected all the questions. Then in that manner, we will do the revision session, combination of the past papers, which is under 2015 curriculum, under Indian Revenue Act number 24 of 2017, since there are no changes till your examination. And again, the questions of the revision kit we will do. Okay. Then this is the starting of the corporate taxation revision session. Okay. Then this is the revision session plan. First I am going under the same format of your paper. Then this is I am starting from the non-resident and international taxation. In that, I think all of you all have the revision kit. If not, go to the CA Sri Lanka website and download. I think under the students tab in the education or examination, I think in the education tab it is there. Therefore, please go and download the revision kit. Then you can do the questions with me. Okay. Then in the revision kit for non-resident taxation, question 1, question 2 and question 3 I am going to do with you all. And again, I thought it's good to take a one past paper question from even this is under 2015 curriculum, Lamai, that's mean before 2020 curriculum, but this has tested the same context because in that time is Act number 24 of 2017. Till your paper there are no changes. Then therefore, this December 2019 question 1 with reference to non-resident and international taxation, we will do it. Then you all in a good position on the question discussion in the way of the question discussion of the non-resident and international taxation. Okay. Then for value added tax, unfortunately, when doing the revision session with the pilot paper, I have done entire value added tax questions. Taking the entire, that's mean till 2000, that under the even under the old syllabus, that 2015 syllabus questions I have done. Then up to March 2021 paper I have completed all. Therefore, again I don't have to discuss the question, then I have selected the questions from the revision kit, the question number 2 and question number 3 and the revision kit for the value added tax. And then only the difference is the rate difference. I have repeated this in many times. Now the rate is the 8% with effective from the 1st December 2019. Then next one is on the resident company taxation tax planning case law. All these things are in your 50 marks question. Then in that question also up to now everything done. Then I thought it's good to take December 2019 question 3 and the June 2019 question 3 because I really need to not only go for the calculation. If so, I am selecting the revision kit questions, but this tax planning and this case laws also I need to touch. Therefore, I have selected these two. Even these are in the 2015 curriculum, Lamai, these are in the same law original enactment under Act number 24 of 2017. Therefore, it's good to do these things before your examination, since I done all the other past paper questions. this is our plan. I am starting from the non-resident and international taxation in the revision kit questions. Then you know, this is now, before that we will look at your syllabus. Then this is your syllabus in the strategic level, corporate taxation, summary of the syllabus. Your pillar is the taxation and law, course unit is the corporate taxation. These are the weightage. In that lamai, this income tax liability of a resident company with the pilot paper I have discussed. Taxation and business decision making also I have done. Taxation of non-resident and international taxation this time completed. Statutory provisions and case law in the revision session, also in the theory session completed. Management and value added tax more or less take in a very good time under the revision session 2020 is completed. Tax planning and advising done, but the remaining part of transfer pricing I have completed in this session, and the contemporary issues in taxation also in this time I have completed. Then more or less you all having a good understanding, good questions with reference to your curriculum learning outcomes. Then this is about your paper. It's now with the online paper lamai, actually this time may be a change, but please keep in mind there is a reading time for you to read very well. Therefore, please maintain the quality of reading, read the requirement well and address it well. Then it's a total marks 100 marks. You have to take 50. Therefore, lamai, even in one question, if you have obtained a mark for 225 marks question, if you have obtained 12.5, then for one 12.5, other 12.5, that 25 is done. For the 50 marks, if you can score 25, then you are pass. I am telling, to take that level, you have to write a lot. You have to do your computation correctly. Therefore, please note that this is not an easy task. Therefore, your theory knowledge and application it to the paper and writing a solid answer is essential. Even when you are doing the calculation, that particular points, assumption, reasons, please write. Then sections, there are two sections you all know, section 1 and section 2. Section 1 comprising 2 questions, 225 marks question, and the section 2 for 50 marks question based on the common pre-seen. Okay. Then open book referential. What are the preferred open book materials you all know? The Inland Revenue Act, VAT Act, NBT Act and the relevant gazette notification. The lot of students asking that about the consolidated VAT Act they can use or not. Actually, it's in the paper, it has mentioned the Value Added Tax Act number 14 of 2002 and its subsequent amendments. Then actually I don't have idea on can you all use the consolidated tax. Therefore, I am telling what in the preferred in the examination paper itself, then it's according to my knowledge, it's the original act and its subsequent amendments. I don't know about the usage of the consolidated act at your examination. Okay, then relevant gazette notification, then please go through the all relevant gazette notification. You all know these things. Therefore, please take that printouts of the gazette notification and have all these things with you. Then this is the introduction part to the revision session. Okay. Then I need to start the session by from the revision kit, the non-resident taxation and international taxation questions. Here there are in the question 1 there are ABC 3 requirements. We will look at one by one. First, I will explain each of these the questions using the whiteboard, and after that, Lamai, we will go to the given answer in the revision kit. Okay. Question 1. Explain based on the meaning of assessable income of a person, resident or non-resident, for the year of assessment from any income source as stipulated in Inland Revenue Act number 24 of 2017, comma, that's mean and how the double taxation of a same income, that is taxation of same income in 2 jurisdictions, could arise. Lamai, when I am starting the non-resident taxation, then when explaining the section for assessable income, I have explained this principle. The double taxation, then it is asking how that double taxation is arising. That's the question. The action verb is explain. The base on the meaning of the, it's a whatever base you should provide the answer, assessable income. Due to the definition of the assessable income, how the double taxation will arise. This is the way. Okay. This is the question 1. Question 1 in the revision kit. Revision kit SL3, which is corporate taxation. In the question 1, in that sub question A, what it has mentioned based on assessable income. Come to this, as per section 4 of the Inland Revenue Act, it is talking about the assessable income of a resident person and non-resident person. Assessable income of resident person and assessable income of non-resident person. Here, assessable income of resident person, it is telling from employment, business, investment and other. Employment, business, investment and other, wherever arise. Wherever arise, that's mean the world income shall liable to pay tax in resident country. Tax in resident country. In here, resident country is what? Sri Lanka. Clear? Then what is given in the assessable income of the non-resident person? When it comes to assessable income of the non-resident person, it is telling that for a non-resident person, the employment, business, investment and other, it is arising in or derived in Sri Lanka. Derived in Sri Lanka, which is we are talking about the source principle. Source principle. Then shall be liable to pay tax in Sri Lanka. Shall be liable to pay tax in Sri Lanka. This is the basis of the assessable income. Clear? Now we have addressed the requirement. In the question it's asking based on the meaning of assessable income. Here the world income should get tax. Here source principle should get tax. This leads to double taxation. How this leads to the double taxation, Lamai? Because think that if that our domestic law principle, section 4 assessable income principle, if this is the same principle in the other country also this is the same principle. If so, Lamai, this person this non-resident person, he is a non-resident to Sri Lanka. Think that other country is a country X. Then here, this non-resident person, the source principal, according to source principal, think he has the employment income. For this employment income, he has to pay tax in Sri Lanka as well as he has to pay tax in country X. Why? The resident country, world income should get tax. Clear? Then therefore, due to the basis of the assessable income of a resident and non-resident person, according to the Inland Revenue Act, there is the concept of what? Double taxation. Double taxation. Taxation. That's why in the question it asks in Inland Revenue Act how double taxation of the same income. That means the two jurisdictions, the taxpayer has to pay tax on the same source. What is double taxation, Lamai? We have under international taxation, I have explained this. Double taxation means first one, same person has to pay tax on same source, particular same period. Fourth one, in two jurisdictions, two countries. This is the double taxation. Why this double taxation arise? Because the concept of the basis of the assessable income. Clear? Then this is asking from you all. We will look at the answer. I have explained this. You have to write all these things. Okay, this is the answer format, how you all arise into the answer. Then we will look at what is the answer given. Come to the given answer for this one. The imposition of income tax or any other tax by any country or jurisdiction is generally through their legislative process. That's mean in a country domestic law legislative process we have to apply. Okay. In that, the respective country chooses on the appropriate basis of taxation to be adopted. In the world, most of the countries, except few countries, impose income taxes, and such imposition by most of them are based on the combination of residence principle and the source principle. Except a few countries such as USA that follow the combination of citizen, resident and source principles, while a few other countries such as Hong Kong adopt the source principle only. This is actually rather you have to, for examination you have to write this answer, but in the revision kit it has elaborated further for you to take the wide knowledge of the application of the domestic laws with reference to the double taxation. Under the source principle of taxation, a country tax shall under the source principle of taxation, a country tax all income from source within its territorial jurisdiction. That means a source principle. Under the residence principle of taxation, a country taxes worldwide income of the person residing within its the territorial jurisdictions. This is the two principles. The nationality principle for the taxation of the income envisage taxation of income of nationals of a state respective of whether it arises in that state or any other state. In the source principle, we are look at the arising in or derived through. That means where the income arise in that country, we have to pay taxes. Come to the second paragraph. As such, a person of a country, that means home country or a resident country, who earned from another country, which is source country, could be liable to income tax in that source country under the source principle, you know that, and also on the same income for the same period in his home country under the resident principle, which we have explained this too. Accordingly, a double taxation of same income in two jurisdictions could occur. This is known as the jurisdictional or international double taxation. That is from a double taxation that occurs when the person is taxed on the same income both by its country on the resident and the country of the source. Even source country, even resident country, he has to pay taxes. Then in Sri Lanka, as stipulated under the section 4, now here they have in the first, the most valid is from starting from this paragraph is very important. Now it's applied to the Sri Lankan law. In Sri Lanka, as stipulated under section 4 of Finland Revenue Act number 24 of 2017, the assessable income of a person for the year of assessment from employment, business, investment or any other source shall be, in the case of a person resident in Sri Lanka, the income from every source wherever the source arises, and in the case of a person not resident in Sri Lanka, the income to the extent that arises from the source in Sri Lanka. This is a taxation basis and that combines the source and residency principle. Accordingly, all residents of Sri Lanka will be liable to income tax in respect of all sources of income wherever within the jurisdictions of Sri Lanka or elsewhere. That's why, Lamai, can you remember, for resident person, the world income, that's mean a foreign income or a foreign source plus local source, both tax in Sri Lanka, the world income. And any non-resident of Sri Lanka will be liable to income tax only in respect of source within Sri Lanka. Thereby, I need to conclude the answer, thereby this leads to the double taxation. This leads to the double taxation. Okay, it's a discussion of the first part of the question. Now we will go for the second part of the question, B. The main objective of entering into bilateral agreement between respective two countries or jurisdictions for the avoidance of double taxation has been the elimination of adverse effects arising from the same income being taxed in two jurisdictions. Now here am I, for this issue, there is a issue of double taxation. To eliminate such issue, we are using the double taxation avoidance agreement. The unilateral arrangements are there, bilateral arrangements are there. I have discussed all of these things. Then the purpose of this bilateral arrangement is to avoidance of double taxation. Then has been elimination of adverse effect arising from the same income being taxed in two jurisdictions. Explain briefly other objectives of countries for entering into double taxation avoidance agreement. When discussing the international taxation part, I have discussed the objectives of the entering into double taxation avoidance agreement. Then I am directly going for the answer, Lamai. Here, the B, these are the particular objectives of the entering into the double taxation avoidance agreements. We will come to the part B of the answer. The preamble of most agreements for the avoidance of double taxation, the recites that the purpose, main objective thereof the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income and capital. The fiscal evasion means lamai the avoid there are non-payment of the taxes in the international transactions. There are illegal attempts, tax evasion by non-payment of the particular taxes. Then that is the first the target, which is to avoid the double taxation and the fiscal evasion. And apart from the avoidance of double taxation, the prevention of fiscal evasion with respect to taxes is the second most objective of the tax agreements. First agreement is the elimination of the double taxation. The second aspect is the second objective is a reduce or mitigate or avoid the fiscal evasion. This is achieved through the exchange of information with parties to the agreement, which is aimed to combat evasion. This is the question asking, the other objective of entering into double tax avoidance agreements are promotion of international trade, encouragement of the flow of investment, technology and technical know-how, creation of certainty and tax stability, provision of mechanism for solution of international tax disputes and prevention of the tax discrimination. Okay, clear? Then these are the other objectives, but two main objectives are the elimination of double taxation and the avoidance of the fiscal evasion. After that, these objectives, it's one of the easy question which we have done also in a theory session. And the next question, the next question is to explain or elucidate the concept of permanent establishment. Concept of the permanent establishment, elucidate the concept of permanent establishment. The elucidate mean lamai explain the concept of the permanent establishment, PE, as defined in the double taxation avoidance agreement. Now see the requirement. Now you have done a Singapore Sri Lanka double taxation treaty, and lamai, when I am doing the pilot paper, I have taken the Sri Lanka China the double taxation treaty. When even doing the past papers, there are many treaties, you all familiarize with these treaties. Then this is asking on the, according to the double taxation treaty avoidance agreement, what is the explanation or what is the concept of the permanent establishment for the purpose of determining the business profit of a non-resident person. This is the main thing is not to just write what is the PE lamai, but keep in mind, I am highlighting this again, to compute the business profit of a non-resident person. To compute the business profit of a non-resident person, keep in mind lamai, there should be what? Permanent establishment in Sri Lanka on behalf of that non-resident person. Please remember that. If not, there is no PE, you cannot tax that non-resident person on behalf of what income lamai? Business income. Okay. Then we have learned various types of the permanent establishment. If there is a fixed base, then it's a fixed PE. There is a construction PE. There are service PE and the dependent agent PE. These are the types of the PE. Then we will come to that part. The part C answer of the last part of the question. Come to here. Every agreement for the double taxation avoidance agreement DTA includes the concept of permanent establishment PE, formulated based either on UN model or OECD model or any other for the purpose of providing a real basis for taxation of business profit of a non-resident person. See the word in lamai, basis for taxation of business profit of a non-resident person. Please keep in mind that. to non-resident person to tax the business income, there should be permanent establishment in Sri Lanka. Actually, the concept of PE is a defined business connection of a resident person of a country having within another country. That means resident person of the another country having a PE in a source country. DTS generally define the include any of the following types of the PEs depending on the purpose. If there, now can you remember, if the 183 days or more in Sri Lanka for a service or a supervisory activities, then it is service PE. If there is a fixed base, maybe in a branch office, maybe in the construction site, maybe in the management, the office, what they are doing, then the under Article 5 of the many double taxation treaties, this has described. Okay. Then first one is the asset type PE, fixed rule PE. That means there is a fixed base, which means a fixed place of business through which the business of an enterprise is wholly or partly carried on. Then construction PE, in relation to construction or assembly project, etc. Service PE, as regard the provisions of services through employees or other personnel. Agency PE, which is a dependent agent in the source country. Insurance PE, as regard the insurance business carried out through a dependent agent. These things you all know, but in this answer, what I need to very clearly highlight the types of the PEs as well as to tax the business income of the non-resident person. You should have a permanent establishment with reference to that non-resident person. Clear? Done. Then it is the end of the discussion of question 1. Now we will go to the question 2. Question 2 is talking about the individual taxation of the non-resident person. We will come to the discussion of that question. Then what is the requirement of the question 2? Based on the above information, ascertain the income of Mr. Naresh liable to tax in Sri Lanka for the year of assessment 18-19. We will take it as 2021. Then we need to take the ascertain the income. We need not to compute the tax liability. Is telling the ascertain the income of Mr. Naresh liable to tax in Sri Lanka. You need to categorize what are the income that Mr. Naresh liable to pay tax in Sri Lanka. Okay. Come to the information. While reading the question, I will take the particular sources. Okay. Then this is question 2. Question 2. Come to the question. Mr. Naresh, a Malaysian citizen. Now see, he is a Naresh is a Malaysian citizen. Malaysian citizen. Okay. Malaysian citizen is an expert of information technology employed by a company in Malaysia. He arrived in Sri Lanka on 1st May 2018. Arrival of the Sri Lanka, it is on 1st May 2018. 1st May 2018 arrival. Then in connection with the project undertaken by the company. Now he is working in it's a Malaysian citizen and working in a Malaysian company, there is a project. Malaysian company and there is a project acquired in Sri Lanka by this company. Now lamai, by looking at this, a project acquired in Sri Lanka, then therefore it has the project detail it has not given, okay, in connection with the project undertaken by the company. To that project he has came into Sri Lanka. Now looking at the information provided, this project was in Sri Lanka before his arrival. Therefore we can assume that this is the one of the PE, maybe is the fixed PE, maybe the fixed PE, it may be a service PE. Clear? Then here maybe a construction PE. Here Lama, you cannot look at the arrival dates and the departure dates and tell and decide the PE, because in the question it has given he arrived in Sri Lanka on 1st May 2018 in connection with the project undertaken by the company. Then it has not given the what is the period that project has undertaken. Then therefore he before his arrival this project may be undertaken. It should be the based on the assumption you have to take it that. Then having completed the work in Sri Lanka, having completed his work in Sri Lanka, he left the Taiwan on 30th September 2018. Then departure is on the 30th September 2018. 30th September 2018. Now we will see the now his 12 months period starting from 1st May 2018 to 30th April 2019. This is 12 months period. This is his 12 months period. Now from month of May, 31 days, June 30 days, July 31 days, August 31 days, September 30 days. Then altogether it's 153 days. 153 days. When it comes to his residence, now we need to look at whether Mr. Niresh is the resident or non-resident. Then in that situation he has in Sri Lanka less than 183 days. Less than 183 days. Therefore, you need to take the conclusion he is a non-resident individual. If he is a non-resident individual, his sources of income, arising from Sri Lanka, arising or derived from Sri Lanka, shall be liable to tax in Sri Lanka. Liable to tax in Sri Lanka. Clear? Now we will look at what are the income he has earned. Details of his income during this year 18-19 are as follows. Remuneration from Malaysia company for full year at an amount equal to 1 million per month, in aggregate rupees 12 million has been remitted to Niresh current account in Malaysia, and the income tax paid thereon is equal to 1.5 million. a DTA is in force between Sri Lanka and Malaysia. Now there is a DTA between Sri Lanka and Malaysia. I am taking the income sources here. Employment income. Employment income. There is a local, I will take as a source of income in Sri Lanka, and the M for the Malaysia, which is his resident country. Employment income, then remuneration from Malaysian company, it's a 1 million, all year it's 12 million, but he has worked in Sri Lanka for the 5 months. Then employment income for here for the 5 months it's 5 million, for Malaysia it's 7 million, altogether 12 million. Done. Then interest income net after 10% tax accrued over year of assessment on the deposit in savings account in Taiwan bank, it's equal to 1 million. There is no DTA between Taiwan and Sri Lanka or Malaysia. Now income source is interest income. Interest income. With reference to interest income, lamai, is it a source in Sri Lanka? It is not the source in Sri Lanka. It's the deposit. The savings deposit is in the Taiwan. Therefore, it's Malaysia in the, it should be tax in the Malaysia, but it is the foreign income. Foreign income, which is 1 million. Then it should be tax in which country, lamai? Resident country. Malaysia, it should be tax. Then next one, allowance paid to Niresh by the project company in Sri Lanka during his service period in Sri Lanka, 5 million. This is in addition to his remuneration in Malaysia. Now this has given allowance paid to Niresh by the project company in Sri Lanka. That's mean from the service fee has paid by that permanent establishment in Sri Lanka is rupees 5 million. Then it is the service income. It's a source in Sri Lanka because it has paid due to his services in Sri Lanka. Clear? Then it's 5 million. This in addition to his remuneration. Now these are the income sources. It should be liable to pay tax in Sri Lanka. It is the 10 million. It is the 10 million. Now lamai, we will look at the Sri Lanka and Malaysia double taxation treaty, and since there is now in the question it has given there is a DTA force between Sri Lanka and Malaysia. Therefore, I will take this Malaysia and Sri Lanka treaty. In here, I will go to the dependent personal services. It's I think 14 or 15. Yes, it's a Article 15 dependent personal services. Here, the subject to the provisions of Articles 16, 18, 19 and 20, these conditions are given. Then if the employment is so exercised in that country, such remuneration as is derived therefrom may be taxed in that other state. But there is a relief given, we will look at the relief. Notwithstanding the provision of paragraph 1, remuneration derived by a resident of the other contracting state in respect of the employment exercise in other contracting state shall be taxable only in the first mentioned state if Malaysia wala විතරයි tax ගෙවන්නේ මේව satisfy වෙනවා නම් නොවෙනවා නම් ලංකාවෙත් ගෙවන්න ඕනේ. A. The recipient is present in the other contracting state for a period of periods not exceeding in the aggregate of 183 days. Then it is less than 183 days. Now first condition is satisfied. Secondly, the remuneration is paid by you on behalf of the employer who is not a resident of the other contracting state. Now yes, the remuneration has paid by a non-resident person. The second one also satisfy. First one satisfy, second one remuneration paid by non-resident person. It also satisfy. Third condition, the remuneration is not borne by the resident of the other contracting state or a permanent establishment which the employer has in that other state. It is not satisfying, lamai. It's a third one or a C, this B, this C, this A. It has given there on behalf of this Malaysian company, there is a project in Sri Lanka. Then there is a permanent establishment. The salary derived through this permanent establishment. Therefore, the C condition is not satisfying. To apply the relief, you know, the all three conditions should be satisfied, but here the C has not satisfied. Therefore, he shall pay tax in Sri Lanka. He shall pay tax in Sri Lanka. Okay, clear? Then we will go to the answer. Given answer, all the three things I have discussed. Now I really need to go for the question to answer. Come to here. Mr. Niresh, year of assessment 1800, even for the 2021 same provision. Niresh arrived in Sri Lanka on 1st May 2018 and departure for Taiwan on 30th September 2018. Accordingly, the duration of his stay in Sri Lanka is only around 5 months during the year 2018 before he departure for Taiwan. According to the facts given and the respective provisions of the Inland Revenue Act number 24 of 2017, Niresh has been a non-resident in Sri Lanka for year of assessment 1819. It is very clear. Then, as such, his remuneration from Malaysia and interest income from Taiwan will not be liable to income tax in Sri Lanka, because he has these are the foreign 1 million is foreign income, will be taxed in the Malaysia, 7 is from his resident country. Then it has done. Then the 5 months remuneration which received in Sri Lanka for that period will be liable to tax in Sri Lanka wherever the payment of such service is made. This is the local to income we have taken. The relief provided under Article 15 of the DTA between Sri Lanka and Malaysia, C, will not be applicable to Niresh. Though his presence in Sri Lanka was less than 183 days, but for the reason that the part remuneration was borne by the project company in Sri Lanka. It has the part of the remuneration was borne by the project company in Sri Lanka. Here the 5 million as well as the service fees also received due to employment income received from the project company in Sri Lanka. Then here remuneration in Malaysia, the full year of assessment is 12. The portion applicable to Malaysia 7, then applicable for Sri Lanka for the 5 months 5 million, allowance for from Sri Lankan company is 5 million. Now Lamai, actually this is a project, from project we are receiving this service income. This is the part of the employment income. Then therefore even this has received from the Malaysian company, then this service fee has received from the project in Sri Lanka, therefore from the PE. And however, Mr. Niresh continue to be resident in Malaysia, he will be liable to income tax in Malaysia on his world income. Nevertheless, under the Article 23 of the DTAs and between Sri Lanka and the Malaysia, Mr. Niresh will be entitled to receive an appropriate tax credit on the income tax paid in Sri Lanka. Now for these, if he has paid income tax, then tax credit he can take as per the double taxation treaty. Okay. This is the end of the discussion of question 2 under the question discussion of the non-resident and international taxation. We will do the question 3 and the past paper question in the next session. Thank you very much.